chapter 2, exercise 8 is one of your chapter 2 problems. So let's go to exercise 8. So it says the company engaged in the following external transactions for November, purchasing equipment in exchange for cash, $23,400. Record the transactions, use the following accounts. So how do you record this? So purchasing equipment in exchange of cash. So what do you think is going to be a debit first? Equipment is an asset. Agree? And if you have watched my part 1 video training for accounting cycle, you would know right now why equipment is debit. Do you know why equipment is debit?
Because it provides an asset to the company.
Yeah, but why is debit? Yeah, equipment is an asset, and asset provides future benefits. Yes. Okay, the professional answer is equipment is debit because the normal balance for any asset is debit. That means if you debit an asset, the asset will increase. So normal balance for any asset, debit. Any asset, debit. Any asset, debit. And if you debit that asset will increase. So if you have equipment, that means you have more equipment, more asset, that means you debit that, right? And if cash goes down, reduces, you have less asset, and in order to reduce your asset, you have to do opposite of normal balance. Normal balance is debit, the opposite is credit. That's the professional answer. So, but did you watch my accounting cycle part 1 video for last week? No, you didn't. I know you don't. I tell you now, but if you watch it, you will see it again. A simple question. Just answer me and you will see your, you know this already. If I give you $23,400 right now, cash, where do you put it? Anyone? If I give you $23,400 cash right now, where do you put it?
Your bank account.
No, right now. You're not in the bank. Right now.
Where would you put it?
Where do you put it? $23,000. Where do you put it? In your
Into
pocket.
cash.
In your
your
pocket.
pocket.
Yeah, in your pocket. Pretty much in your
Common
hand.
sense. Am I asking hard question? No. If I give you $100, where do you put it right now? In your pocket. Agree?
Yes.
Okay, why do you
Yeah.
put it in your pocket? Because pocket is the closest place to you. It's the safest and closest place to you. Agree?
Yes.
So anytime I give you $100, where do you put it? In your pocket because it's close to you. Agree?
Yes.
Okay. So now, because of that, you learn that if I give you cash or any asset, cash or any asset, as soon as I give it to you, you put it in your pocket close to you. Agree?
Yes.
Okay. So equipment is any asset. Agree? And you are right there standing next to equipment. From here that you're standing next to equipment, which one is closest place to you? Is it debit close to you or credit is close to you?
Debit.
So you put it in debit. Put it in your pocket close to you.
Mm-hmm.
Got it? So now let's look at cash. So if you pay someone $100, is gonna go into your pocket or out of your pocket?
Out of your pocket.
Out of your
Far
pocket.
away, right? Out of your pocket, far away. So from here that you're standing next to cash, which one is far away? Debit is far away or credit is far away?
Credit.
Credit.
So that's it, simple like that. So I'm not teaching you accounting. I'm just teaching you, not teaching you, I'm just saying what is the normal thing of doing something about asset. So if you get any asset, where do you put it? In your pocket, close to you. which is in this case, standing next to equipment, debit is close to you. How about cash? If it goes out of your pocket, it's going to go debit or credit?
It's gonna go to
Far away. Out of your pocket is far away. So that's a credit. So by just doing that and don't know anything else about accounting, you can easily do this journal entry. That means you can journalize the transaction of buying an equipment for $23,400, which is because you get the asset, you put it in your pocket close to you, that's debit. Obviously, the other one, whatever it might be, it should be credit side.
Mhm.
And happens to be cash, which is an asset, just by chance, happens to be an asset. And if you think about the same thing, you say, wait a moment, your cash goes out of my pocket, far away, credit. Yeah, that's correct. So there you go. But what you do is just make sure that first one is correct. If the first part, the debit part, is correct, the credit part will end up correct automatically. Why? Because something has to be debit, something has to be credit, no matter what. Any question? So for debit, to register and record any transactions, you have to do a debit and a credit. Debit and credit means nothing. Remember, debit and credit means nothing. It's just a word. Means absolutely nothing. So equipment is debit here because you get the asset, put it in your pocket close to you, right there. The closest is debit. And cash goes out of your pocket. It's an asset, far away. So you're going to have less asset. Goes out of your pocket, far away. So let's try the second one. And here we go. Provide services to customers and receive cash of $6,800. Okay, based on that, you can easily record this transaction now. How you do that? You say, okay, I got cash. If I get cash or any asset, I will put it in my pocket close to me. So if you get cash, it is debit or credit? Debit, close to you. See how close it is? Credit is far. And the next thing, which is creating a service revenue, has no other choice, has to be on the credit side. So if you do the first part right, the other part ends up to be correct automatically. And by just doing this, you start learning that, wait a moment, now service revenue is increasing by $6,800. So what's the normal balance for any revenue? Normal balance for any revenue? Credit, revenue, credit, revenue, credit, revenue, credit. Normal balance for any asset. Asset, debit, asset, debit. That means if you debit asset, asset will increase. Debit asset, asset will increase. You credit revenue, revenue will increase. Normal balance for revenue, credit, revenue, credit, revenue, credit, asset, debit, asset, debit. But for now, while you are practicing this to learn, you can do it just like a piece of cake because I gave you a tool that you can easily identify what the journal entry is, even with 2 minutes of accounting knowledge. And whatever I just told you about how to figure out what is the correct way to do journal entry, it's not written in any book or any class or any instructor. This is just me. So don't think you explain this to another instructor and he will say, oh yeah, I know that.
Okay, so Professor,
Yes,
in this scenario, so the cash is basically you receive the money
Mhm.
from your service that would be pocketed to your pocket right away to cash, and then the service revenue that you received would go straight to credit.
yes.
Oh, okay, from the service you provided. Okay.
Yeah, so by doing this, you learn that anytime you want to increase revenue in your balance, then you need to do credit. Normal balance for any revenue credit, revenue credit, revenue credit, revenue credit. Asset debit, asset debit, asset debit.
How does it increase your credit?
How does it increase your
How does it increase your revenue by putting it in credit?
again, you see, do you remember I said if I give you $6,800, where do you put it?
Mhm.
Normal question, everyday question. If I give you 6,800, where do you put it? You said in your pocket, right?
Yeah.
Because it's close to you. Agree?
Mhm.
Okay. So this part, it's a normal everyday conversation. Do you have anything against that?
No.
No. Okay. So you got that one 100% right, starting today till end of your life. Now, the next question is this. That's you said, how come revenue goes into credit and it will increase? And the answer is, I don't know. All I know is if I get cash or any asset, I put it in my pocket, it will increase, which is debit, close to me. You see, debit, close to me. The other one comes right automatically, because if something is debit, then something needs to be credit. That's the answer, short answer for right now. But the professional answer is you need to memorize it. What's the normal balance for any revenue? Credit. Revenue, credit. Revenue, credit. That means if you credit revenue, the revenue will increase. If you credit revenue, revenue will increase. So anytime you want to increase your revenue, you credit that. That's a professional answer, but it's hard because right now I'm gonna tell you, you have to memorize it.
Okay.
But I don't want you to start with that, which your book and everywhere else says do it that way. I say, okay, forget about memorizing. I don't like to memorize anything. I'm very bad in memorizing. So what I'm saying is just use your common sense. If you get cash or any asset, put it in your pocket. That will be a debit. The other one, whatever you want to call it, I don't care what you call it, it's a credit. Simple as that. Yes, in matter of 5 days from now, you should get used to these normal balances. But as of this moment, I'm not going to push you to memorize right away. I'm just saying, just follow my simple example of everyday life. You get asset, cash, put it in your pocket, close to you. The other one comes right. But while you are doing this, repeat, normal balance for any revenue, credit, revenue, credit. That means if you do credit, revenue will go up. And you know what the T account is, right? Do you know what the T account is? No?
No.
Okay, so let's do this, because every time you do a journal entry, you need to post this in the T account. The whole idea is to have a record of every single thing happening in a business. So in this transaction, you bought equipment for $23,400. So I'm going to stop sharing here, and here we go. So you bought, you see, we have general ledger and bunch of T accounts for everything. So anything happens in a business, it goes in a T account. So we can always see what's going on. So here we have cash, and let's say we have a lot of money, let's say $100,000, you see? So cash goes in debit or credit? Debit, credit, debit, credit, debit, credit. You see, debit is always on the left side, credit is on the right side. So you have a lot of cash and you open a business and you call it common stock. You issue stock, right? If it's a corporation, what do? You issue stock. If it's a sole proprietorship, you call it owner's capital, right? If it's a corporation, you issue stock, raise $100,000, that's a debit. and you credit 100,000. Make sense? So
Yeah.
normal balance for common stock is credit, common stock, credit, capital, credit, common stock, credit, debit, asset, debit, asset, debit, asset, debit. And now you just bought equipment for, God, how much was that? Let's see, 1,300. Okay, so 24,300. You did the journal entry. Now you post it to the T account. You spent cash, 24,300. Cash goes out of your pocket. That's a credit. And you buy equipment. Equipment is an asset. And that's debit of 24,300. You see, I posted to the T account. So equipment is increasing. If you look in the equipment T account, you can tell me exactly how much equipment I have. You can tell me exactly how much common stock I have, and you can tell me how much cash do I have. How much cash do I have now? 100,000 on the debit side, minus 24,000 on the 24,300 on the credit side. And whatever the balance is, do the math. That's your cash balance. Sharing my screen again. 23,400. I was correct. 23,400.
23,400.
23,400. Okay, anyway. So whatever it's in here, you need to transfer to the T account. Do you see the T accounts that I'm showing here? Do you see my pen?
Yes.
So you do the journal entry with a date here next to it, and then you post it to the T account, which I did. But I just did the first journal entry for creating this company. So I put $100,000 in cash, and I raised capital by issuing common stock. In general, you know that a business can raise capital two ways, either issuing stock, equity financing, or borrowing, which is debt financing. So there is two ways for any business to raise capital: equity financing, debt financing. Equity financing comes from investors, and company may choose to pay dividend to those investors on an annual basis, quarterly basis, to share a portion of profit with them, but may choose. If they don't want to do it, that's optional. But when you borrow debt financing, then you have to pay interest. It's mandatory. The difference is if you pay interest, which is mandatory, it's a tax deductible item. You call it interest expense. You deduct from your income and you pay less taxes, income tax. But dividend, it's optional. However, it's not tax deductible item. So you cannot say, oh, I pay dividend and I deduct it from my taxes. You can't do that, because you're just sharing a portion of profit with your investors. That's all that you are doing. So next one is cash. You debit cash and you recognize revenue. So cash goes into your pocket. That's a debit. The other one, whichever you call it or whatever you call it, service revenue, online sales revenue, I don't know, consultation revenue, tax preparation revenue, whatever revenue you want to call it, that is credit no matter what. And by just doing that, you just learn that credit revenue has a normal balance of credit. So let's post this. So right now I'm going to post it to the T account. I'm going to pin my stop sharing. And that was 6,800, I believe, right? So here we go. We're going to get 6,800 debit. So cash will increase. And then we recognize revenue. Credit 6,800. So now, all of a sudden, if you ask me right now how much revenue you have, all I'm going to look is this revenue. And there you go. I know how much revenue I have. If you ask me how much cash you have, I'm going to look at here. I say 100,000 plus 6,800 minus 23,400. That's my cash. Make sense? So let's remove pin again. Go back to sharing. Here we go. Next one. Paid current month's rent. So if you pay current month rent of $1,300, the easy way that I can say you can do it, I say, think about first your cash that you are paying. The cash that you are paying, the cash account that you are paying, that means your cash goes out of your pocket far away. Agree? So first thing I'm going to tell you is saying, okay, just write this one first. Cash goes out of your pocket. That's a credit. Easy. Therefore, the other one, whatever it might be, will be a debit. In accounting normal, we put debit at the top, credit at the bottom. And if I want to write cash as a credit, I just leave some indent here and then write my cash right there. That way, I show that cash is on the credit side. If rent expense is all the way to the left, that's without indent, that's a debit. Anyway, so first thing first, I do cash, credit, then I come back and I say something has to be debit, no matter what. I need a name. Why did I pay this? Oh, that's for current month rent. Then easy, I can call it rent expense. 1,300. Questions on this? Journal entry? Is it hard? Is it confusing? Anything?
It's self-explanatory.
Yeah. Based on what? Based on this. Cash goes out of your pocket far away. As soon as you do that, the other one ends up to be debit. Okay, so now that I did the journal entry, technically you need to take your notepad and post it to your T account. So here we go. I'm gonna post $1,300 to my T account and $1,300. So that's a debit rent expense, right? Rent expense, debit, $1,300, and cash is credit, $1,300. Correct? So if someone asks me right now how much cash I have, I can easily calculate 100 plus 6,800 minus 23,400 minus 1,300, and that's my cash balance. How much rent expense do I have so far? 1,300. Revenue, common stock, equipment. So here you see why an accountant has answered to everything, because an accountant is so organized and he can prepare financial statements, he can give you information, and you can get all your questions answered just because you have an account. Add all your debit sides of your T accounts plus credit sides. It has to be equal on the debit side and credit side. So you see here, debit and credit is equal. Debit, credit is equal. Debit and credit is equal. So if you add them up, still your debit side and credit side in your trial balance will be equal. You have to be always equal on debit side and credit side in your trial balance. Next item says, okay, you purchased office supplies on account. On account, that means on account. You didn't pay cash, and you normally go to Office Depot and say, okay, I want this stuff. Please put it on my account. Put it on my account. That means I have an account with you. Put it on my account. Send me an invoice. That's what it is. Send me a bill. Okay. So you're gonna buy supplies. Supplies is an asset. It's things that you use in your daily business operation, like copy papers, pencil, eraser, ink cartridge, let's say, tape, anything like that. Those are supplies. What's the difference between supplies and inventory? No one knows? Supplies and inventory. What's the difference? Okay, supplies is something that you buy, like tape, to use in your office. That's a supply. But inventory is something that you buy in order to sell. So if you are in a business of selling t-shirt on Amazon, so when you buy inventory like t-shirt, you keep it in the inventory room, then you get an Amazon order, then you ship it to your buyer. Inventory is something that you buy to sell. Supply is something that you buy to use. Got it? Okay, so supplies, that's an asset. If you get any type of asset, where do you put it? In your pocket, close to you. Agree? If that's correct, 100%, and it's piece of cake, guess what? The other one, whatever it might be, it's credit. And what is it? Because you bought it on account, that means you have to pay this later on, and that's an accounts payable. And if you bought this from, let's say, Office Depot, then you call it accounts payable dash Office Depot. Accounts payable is the main account, but below accounts payable, the main account, you have bunch of accounts payable as a sub account, like accounts payable Office Depot, accounts payable Home Depot, accounts payable one of your vendor number 1, accounts payable vendor number 2. Make sense? But if you add up all those sub accounts, technically it goes in accounts payable in general. So here is accounts payable credit. So accounts payable is a liability. Normal balance for any liability is credit. Liability, credit, liability, credit, liability, credit. So here is supplies, $1,000 debit, accounts payable, credit. Now, as soon as you do this journal entry in a accounting software, right next to it or below on the right hand side, let's say, there's a button says save. That means post it. So save it in the accounting software, that means post it in accounting class. So post it to the general ledger. Because this is not accounting software, so you have to post it yourself. There's nothing here to click, say save. So post it to the T account. So in order to post it to the T account, I'm gonna stop sharing, pin on the video, and here we go. So accounts payable, supplies. So supply is $1,000. That's a debit. Accounts payable is a credit. You learned here is bunch of transactions, and also I did show you how to post it in a T account. And every T account is a separate account for a separate thing. Cash, common stock, equipment, revenue. When here I say cash, in general, remember, you might have a checking account, you might have a saving account, you might have 2 checking accounts. So all those accounts will have a separate T account. So you can call it cash dash checking account, cash dash saving account, cash dash petty cash, or just call it petty cash. Those are all cash accounts combined. You tell them cash, but here it's a class format, so I'm not gonna have saving account, checking account, and too many cash account. I'm just gonna show you one T account, call it cash, and that will be enough for our purpose. So that was the problem 8. There's one more before we finish this. One more is salaries expense. So salaries expense, it's hard. Let's say we don't know how to do it, but I know one way because we learned that already. So cash goes out of my pocket. Cash is an asset. Cash goes out of my pocket far away. I know that 100%. So I'm going to do that first. Then I'm going to up one line and say debit something for 2,100. And then I say debit what? Gosh, let me think about it. Pay current month salaries. Okay, salaries. So I'm going to call it salary expense. Yeah, that makes sense. So here we go. So salary expense debit. 2100, cash credit out of my pocket 2100. You see, so if I do this one right, because we learned that already, everything else will fall correctly in right spot. And by doing this, you can start learning that the normal balance for any expense is debit. Normal balance for any expense, debit. Any expense, debit. Expense, debit. Expense, debit. How about normal balance for any liability? Any liability, normal balance, credit. Liability, credit. Liability, credit. Okay, so let's do that. I did it. Normally, I need to post this to the T account. So let me post it because there's no software here to click save. So I'm going to post it manually. So I'm going to 2100 salaries expense. Stop sharing. That's the pin. Okay, so 2100 cash credit. Salary expense 2100 debit. Expense normal balance debit. Expense debit. If I do debit on expense, expense will increase. Questions? Okay, so let's say half an hour later, you call me, say, hey, how much expense do we have so far? I know right there. If you ask me, how much cash do we have right now? Right there. 100 plus 68 minus 23 minus 1300 minus 2100. The answer is right there. So I have all the answers anytime. There is just again one more thing to share. There is two ways of doing accounting. One of them is cash method. One of them is accrual method. In accounting books, we always do accrual method. For big companies, we always do accrual method. For a small business, you might do cash method, not a problem. But GAAP, generally accepted accounting principle, the US accounting rule, GAAP, says that you need to do accrual method. Why? Because accrual method provides a better, more clear picture of your activities.
Professor, if I can ask, do you think we can look at one more time, number 5, the salaries expense cash one more time?
In the T account?
Yes, please. I just wanted to revamp it really quick on my mind.
Yeah. Where is it? Stop sharing. Pin this video. Right there. So cash goes out of your pocket. That's a credit. And salary expense will be debit. Yeah. So why is that? Because remember I said cash goes out of your pocket. That's a credit. If cash is credit, then supply expense is debit. Again, you start learning. You have to repeat. You have to say, okay, looks like expense is increasing if we do debit. Then normal balance for any expense is debit. Expense debit, expense debit, expense debit, expense debit. So next time if I ask you what is the normal balance for expense, you say debit. But today we are just taking it easy, just following my easy, funny example of how to do things, and you will be able to do it. And the way that I explain is not in any book or any other accounting class. Don't tell to anyone because they don't know what's going on. They never heard that and they will laugh at you. But the point is, don't tell them. Just do it right. And they think, oh, you are doing this for almost a year or so. They don't know that you just learned accounting, I don't know, 30 minutes ago. Right? So that's the point. If cash goes or any asset goes out of your pocket, is credit, far away. If cash goes into your pocket or any asset goes into your pocket, that's a debit. You receive cash, put it in your pocket, close to you, that's a debit. So if you remember that concept, it will be easy to do journal entries. What we did is solving a problem, but going very deep into it. So you have similar problems probably coming in chapter 2 that you need to do, but the concept is the same thing over and over. As long as you learn this one, you should be comfortable doing the rest of it. Obviously, there's a PowerPoint you have a very nice book that explains one by one. And also I have the accounting cycle, four-part accounting cycle video, which you can watch that.
Thank you.
So see you next week. Again, make sure
Thank
study
you,
on a
Professor.
weekly basis. Don't leave it anything for the upcoming week. Finish every chapter on time so you can move with the course on a weekly basis without falling behind.
Okay,
Do
thank you,
assignments on a
Professor.
weekly basis.
Thank you.
You're welcome. Bye-bye.
Thank you,
Bye-bye.
Professor.
Thank you.
Bye.
Bye-bye.